Welcome to Dad Gives Advice. My name is Orestes, and in this video, I want to continue my series on investment vehicles. And today we're going to be talking about bonds. Now, before I start, I just want to remind everyone that the information that I provide in these videos is for educational and informational purposes only, and nothing that I say should be taken as personal advice to any particular individual. Everyone's specific financial situation is different, and you should never take general advice that I give here as something that's directed specifically to you. If you want to learn more about investment vehicles and how they relate specifically to you, you should talk to a personal financial advisor and have them go over your specific situation before taking any action. So anyway, having said that, let's get started. This is another one of these topics that I wish I'd known a lot earlier in my life. Bonds were always kind of a mystery for a long time until I kind of dug in and figured out exactly what they were about. And why they're important, and also why sometimes they're not as safe as they seem to be from the outside looking in. We'll get into that in a couple of minutes. So bonds are what they call debt instruments or debt vehicles. And essentially what's happening there is a company, a municipality, or a government is borrowing money from the investor. The entity or the issuer, we'll call it in general, is issuing a bond and saying, I will borrow money from you, the investor, and in return, I'll pay you back an interest rate, an amount of money over time, and I'll pay you back your principal at the end. Hopefully that happens. In some cases, the issuers do default, and that may happen more in the corporate side, less, of course, on the government side, but it can happen that issuers default and may not be able to pay all of the interest that they promised to pay, and they may not be able to pay back all or any of your principal. So these things are not completely safe. There's some risk involved. I should point out that bonds are typically more appropriate for older investors and investors that are typically approaching retirement. Although, like I said, every case may vary, and there may be some case where some young people will benefit. But generally speaking, younger people probably don't need to look at bonds, don't need to invest in bonds because they have a longer time horizon. And for that longer amount of time, you're going to want to have money invested in vehicles that have a higher potential to earn compounded interest over time. I'll talk more about that in other videos, but just leaving it there for now. Younger people tend not to need bonds. Some do. Again, talk to a financial advisor, figure out what your specific situation is. Older people tend to shift money into bonds as they approach retirement in order to put them in a safer place so that if, for example, the stock market should drop as they're approaching retirement, they have at least a good portion of their money in bonds so they can recover from a stock market drop as they're approaching retirement or in retirement itself. Bonds can vary in the time or the maturity that they're provided in. So you could buy bonds that are short term, just a few weeks to months, to long term, which could be as much as decades. And the interest that they pay depends on that time. So we can actually graph that on a chart. And if we put on the vertical axis the interest paid and on the horizontal time, then the longer amount of time that you're going to lend out money, the higher interest rate you'd expect to be paid. So you're going to end up somewhere here on the graph. And the shorter amount of time that you invest money, then of course, the lower the interest rate you're going to get paid because you're going to get your principal back fairly quickly. And so you'll see that if you try to buy a very short-term U.S. Treasury bill, for example, you're going to get a very low interest rate versus a longer-term government bond or a corporate bond or something like that. And then, the graph kind of ends up looking a bit like that, where in the longer you put out money, the higher interest rate you're likely to be paid. There's another relationship that we can draw on another set of axes, and that is the interest rate or the interest paid versus the safety or the security or how safe. Let's call it risky. So let's say how risky the investment is or the bond is. And so on this graph, the further to the right, the riskier the investment, and the higher up on this side, the higher the interest paid. And again, in this situation, you're going to end up getting higher interest payments, a higher interest rate or a higher bond coupon rate is what it's called. If the investment is more risky than if you would get a lower risk investment, you'd get a lower interest rate. And that graph ends up looking very similar to the previous graph, but you've got different axes there. And if we can put some names on here, some categories on here to kind of explain how these things work. And so on the lower left end over here, you're going to have things like U.S. government securities or treasuries. Those are the kind of bonds that are going to be the safest, but they're also going to pay the lowest amount of interest because they are the safest. And on the upper extreme over here is going to be something like small company bonds, because these are companies that are starting to grow and they're going out into the bond market, into the debt market, and asking for money from investors to grow, to build new projects, to expand, to hire more employees, to expand into new office space, and so on and so forth. And those are the most risky because a certain percentage of those smaller companies end up failing and end up not being able to pay their bonds. So somewhere in between is probably something like blue chip companies, which you've heard of before. And these are like the IBMs of the world and the Microsofts of the world, where they will be more secure, safer options, safer companies to buy bonds from. But because they're safer and they're likely to pay back, their interest that they're going to pay is going to be somewhere in the middle between U.S. government treasuries and small company bonds. So that's how that relationship works. If you saw my video on stocks, you'll remember that I talked about the OTC market, or it's called over the counter. And that's where most of these bonds trade. What happens is that the issuer will issue the bond, whether it's the U.S. government or one of these companies or a municipality. Municipalities, would fit in here somewhere, right? In the middle between blue chips and U.S. treasuries. These issuers will issue these bonds and will sell them to broker dealers, and the broker dealers will then trade them on this over-the-counter market. The same market that we talked about on the stock video, where that trades 24/7. And actually that market is one of the biggest in the world, and the biggest volume of trades that happen there are these bond trades. So that's kind of how the mechanics of how that works. It's all done through broker dealers on that market. Missed an R there. As I talked about it earlier, just now, U.S. treasuries are going to be the safest bonds. These are bonds that are backed by the full faith and credit of the U.S. And so 99.99999% of the time, they're going to be paid back, and you're going to end up getting your interest and principal payments as a result of having bought a U.S. Treasury. And as a result, they're going to pay the lowest interest. So if you go out and look at U.S. Treasuries and what they're paying, it's pretty low interest rates. Recent announcement, if you're watching this in the first half of 2022, recently the Federal Reserve has raised interest rates, and so the interest rates on treasuries are going a little bit higher, but still they're the lowest that you're going to get versus any other kind of bond that you might see from like a corporate entity or corporate issuer. The appeal of U.S. treasuries is that you're going to have safe and secure principal. The money that you invest in them, you're likely to get back, and you're going to preserve capital, is what it's called. You're not likely to lose your capital. So if you buy $1,000 U.S. Treasury, that is going to pay you 1% over the next year or so, you're going to get 1% of that 1,000 plus the 1,000, more than likely. And so that preserving of capital, you're not going to tend to lose money on your initial investment. You're at least going to get your investment back and a little bit of interest. Now, the downside of that is, of course, that these lower paying interest securities are not going to keep up with inflation. And, if inflation is, 3%, or nowadays it's a little higher, let's say 5 to 7% or even higher, then you can see that if you're only getting 1% on your money or 2%, you're not going to meet the rate of inflation, and you're going to end up losing out over time, because as time goes by, the value of your money will drop and your return is not keeping up with that rate of inflation. So that's the downside of buying, like say, putting everything into U.S. treasuries. That doesn't work. There are several kinds of U.S. treasuries, and they're kind of divided in the term or the maturity time that they have for investors. The simplest and the shortest lived ones are called Treasury bills or T-bills. And T-bills are the shortest duration. So they'll mature in time frames of something like 4 weeks to 1 year, and they have maturities in between. And so being that they're lower time frame, of course, these are going to be the lowest interest paying ones. And T-bills are unique in that they don't have a stated interest rate. They don't say, well, you're going to get 2% on this money or 1% or what have you. They say they're sold at a discount to par value or face value. So bonds have a par value. Typically, if a value or price of a bond when it's being sold is not quoted, it's going to be about $1,000. Typically, that's what a bond is going to cost, $1,000. And so that's called the par value or face value. And when you buy a T-bill, it doesn't say it's going to cost $1,000. It's going to pay 1% interest, as an example. You're going to buy it at a discount. You're going to say, buy this T-bill at like $970, let's say. So you're buying it at a discount from par, and when it matures, you're going to get $1,000. So your interest then is that difference, which is the $30. That's how the T-bills work. The next set of government securities, U.S. government securities, are called Treasury notes. Treasury notes are of an intermediate nature, and they will have maturities of 2, 3, 5, and 10 years, typically. And because they're of a higher maturity time period, they're going to pay a slightly higher interest rate, and they will have a stated interest rate called a coupon rate. And so you might buy a 10-year T-note. That'll pay, let's just say 5%. And what that means is that for that 10-year period, you're going to have semi-annual interest payments of 5%. So and again, let's say it's $1,000 bond, and 5% on $1,000 is $50. And so twice per year, semi-annually, you're going to get $25. And on the very end, the very last payment, you're going to get your initial investment, $1,000 plus $25 equals $1,025 on your last payment. And it's as simple as that. That's how these things work. And finally, from the U.S. government securities or U.S. government treasuries, there are treasury bonds, T-bonds. And these have a maturity of 10 years or greater, 10 years, and some 20, 30. I don't know if there's any higher than that. I think 30 is the highest lately. But the U.S. government can decide to make higher duration bonds if they wish. And they work in a similar manner as the T-notes. Same thing. You have a stated price of the bond, you have a stated interest, and you get semi-annual payments on your principal, and at the end of the period, whatever it might be, you get the last interest payment and your principal back returned to you. The U.S. government also issues or works with semi-government and semi-government, semi-private agencies to issue mortgage and student loan-backed debt instruments. And these you may have heard of already, and I'll go into those in the next section here. The first one to talk about is Ginnie Mae, Gnma, and they all have these cute little names that they came up with that kind of sound like their acronym. Okay, so Gnma or Ginnie Mae's this is the Government National Mortgage Association, and these are actually backed by the full faith and credit of the U.S. So these are the safest of these items in this next section. Full faith and credit of U.S. backing. And so these, you're very likely to get your money back and to get your interest payments. The rest that I'll mention on this section are not fully backed, but what they do is they have lines of credit with the U.S. Treasury. So there's kind of like a hybrid relationship with them as being semi-private organizations and government entities kind of at the same time. Ginnie Mae buys insured mortgages that are handed out by the Federal Housing Authority. That's a federal government agency, Federal Housing Authority, that helps people buy homes by giving them loans. By the Veterans Administration. So veterans have a way to get a loan from the government if you're a veteran of the armed forces, and by the Farmers Home Administration Corporation, or the Farmers Home Administration. That's another FHA, so I'll just spell that one out. Farmers Home Admin. And what Ginnie Mae does is it buys insured mortgages from these three entities and pools them together and securitizes them. Pools and securitizes these mortgages, groups them together, and then sells these groupings or these pools of mortgages, again, to broker-dealers on the secondary market, and then broker-dealers will then in turn sell those to investors on that market. The next semi-government agency, and again, these are now the ones that are not fully backed but that have an affiliation with the U.S. government. The next one is FNMA, or its cute name is Fannie Mae. And FNMA stands for the Federal National Mortgage Association. And Fannie Mae buys government guaranteed mortgages and mortgages from banks. So in some cases, when folks go out and go get a home loan from a bank, that loan may actually be turned around and sold by the bank to an entity like Fannie Mae. And then it does the same thing as Ginnie Mae. It groups those together, pools them, and sells them to investors through broker-dealers on the secondary market. The next one is called the FHLMC, and this one's got a funny name, or a cute name, called Freddie Mac. And it's very similar to Fannie Mae. In this case, Freddie Mac buys conventional residential mortgages. So not mortgages that are backed by the government, but mortgages that are just backed by conventional banks that are out there lending money for folks to buy homes. Up next is SLM Corporation, and this one's nickname is Sallie Mae. And Sallie Mae will buy student loans and group them together and sell them to broker-dealers, who will then sell them on the secondary market. All of these will pay semi-annual interest, except for Ginnie Mae. Ginnie Mae bonds or Ginnie Mae investment vehicles pay monthly interest. And then the rest of these will pay semi-annual interest. There's other debt instruments that the U.S. government issues, and I'm not going to go into them here for the sake of time, but you might hear of things like TIPS and strips and Treasury receipts, and they're available out there. If you want to look further into them, you can. For example, TIPS are Treasury inflation protection securities, which are there to provide investors with a hedge against inflation. And those are becoming more popular nowadays as inflation goes up during this early part of 2022. But there's some drawbacks to those too, so I won't get into the details of that, but you may want to look into that on your own. The next category to talk about is municipal bonds. So we'll call these munis for short. You may have heard that term be used before as well. And municipal bonds are debt instruments that are issued by, guess what, municipalities. They'll be issued by state governments or local governments like cities and counties. These munis come in three major categories, and they're called general obligation bonds, or GO bonds, general obligation bonds, general revenue bonds, and industrial revenue bonds. And we'll call these GR for short, and we'll call these IDRs. GRs and IDRs for short. And remember, GO is general obligation. General obligation bonds are going to be those safest ones coming from municipalities, because for like state governments, they're going to be backed by, or they're going to be secured by state revenues like state income taxes and state sales taxes. And for cities and counties, they're going to be backed by property taxes. And sometimes sales taxes, some cities will tack on like a 1% sales tax on top of the state sales tax. And these are generally going to be used to fund ongoing operations of the municipality, or parks and new fire trucks or things like that the municipality needs to continue to either replace equipment or for ongoing operations. Revenue bonds are going to be self-supporting. So revenue bonds are self-supporting, and that means that there's going to be some kind of usage. They're going to be issued in order to pay for something that the general public is going to eventually pay for using. So some things like toll roads and bridges, hospitals, and anything of that nature that the people that live in the municipality are going to be using and paying for. And so because it's going to have that usage, that's going to generate revenues that is going to go on to pay the bond interest and then repay back the bond principal at the end of the bond term. So these tend to be on the safer side, not as safe as go bonds, but on the safer side. They can actually lose money, and if the usage for a particular thing that was built is less than what was anticipated. And so these can actually end up defaulting, just like any other bond that would be issued for a riskier kind of investment. They're going to be safer than the next category that I'm going to talk about. Sometimes these are used to fund special things like rural hospitals, which are special cases. And in something like a rural hospital, the state legislature or the municipality might end up declaring what's called a moral obligation. And in that case, they're saying that nobody needs to worry about the usage being too low for the bonds to fail and for the facility to fail, because they know that for a rural hospital, there may not be enough usage. There may not be enough patients to warrant the fact of keeping the hospital open and running. But the legislature is saying we have a moral obligation to keep it open regardless of the fact that it's not used and it might be losing money, and we'll shore up that loss by funding it from other state funds like sales taxes and income taxes and things of that nature. Because if something like that were to close down, then you've got an issue where you might have people with a 200-mile radius in a rural part of the state that they can't get access to a hospital, and you can't have that. So those are special cases sometimes where a legislature will guarantee that the facility will stay open even if the usage is too low to warrant it from a business perspective. Industrial revenue bonds, or IDRs, are kind of a special case where it's a partnership between the municipality and a corporation. And these are typically issued in order to build things like sports stadiums and arenas. And what's happening here is that the municipality is issuing as a municipal bond, but a corporation is actually the one that's backing it. And the corporation is the one that's going to be responsible for paying the interest payments and for paying back the principal to the investors. These are going to be the riskiest of the three because sometimes these things fail. Sometimes there's anticipated usage of something like a sports arena, a new stadium, new ballpark. And when it's built, they don't come. The fans just don't show up in the numbers that they thought they were going to show up in. So these could end up paying less or failing as a result. So these are the riskiest of the municipal bonds. There also exists short-term municipal bonds, like there exists short-term U.S. Treasuries. So short-term munis. I'm not going to go into detail on these because there's a lot to talk about here and we don't have the time to cover it. But I just want to say it in passing. And these are typically anticipation notes. And what that means is that when a municipality anticipates revenue, and they know that a new toll road is going to go up in the next year, or they know that they're going to build a new community and that's going to bring in more revenue as far as the people that live there paying property taxes and essentially growing the city, they can actually issue what are called anticipation notes and sell bonds based on that fact that we're going to have in the future we're going to have more revenue than we do today. It's like I said, it's a little bit of a big topic by itself, so we don't have time to cover it, so I won't cover it here, but just mention it in passing. The next major category of bonds are, of course, corporate bonds that I kind of talked about earlier on in the video. And these are, of course, issued by corporations, companies, and they're issued in order to raise money for either ongoing operations, for growth, to buy new equipment, to hire more employees, whatever a company thinks they need money for and they don't just have it on hand and they need money to fund the next level of growth, they could issue bonds in order to do that. And they work in a very similar fashion. You pay the company money, they pay you back interest, and in the end, hopefully they pay you your principal back. Now, these, of course, are the riskiest of the categories that we've talked about, because some of these companies end up failing and they end up not being able to pay back the money. And so the investor needs to be very aware of that. Some of the bonds in this category are called junk bonds. You'll hear that name talked about. And that's just an old term that was used and just kind of caught on for these bonds because they're not as safe as the US Treasuries and other higher rated bonds. It doesn't necessarily mean that they're all trash and that they're all going to fail. Some of them are fine. They pay a higher interest rate. So you could take a little bit of a risk with maybe a smaller percentage of your bond portfolio and put it into junk bonds to make a little bit of higher rate. And that's typically what people do, is they have a mix of bond types and they'll put a small percentage of their overall bond money into junk bonds to raise the overall percentage just a little bit, but not too much in junk bonds because some of them do fail. As far as tax implication goes, corporate bonds are taxed at, corporate bond interest is taxed at all levels. So interest taxed at all levels. And munis are tax-free at interest. The interest payments are tax-free. This is all just interest payments. Interest. Tax-free at federal and state level, but only if the issuer, the state, is the home state of the investor. So it's important, if you want to use municipal bonds as a tax shelter, that where you're not going to be paying taxes on interest, you're going to want to buy municipal bonds that are issued by your state. If you live in California and you buy a municipal bond that's issued in Florida, then California will tax the interest on that. So that's something to know. And the exception here is IDRs that we talked about in the previous section. IDRs, because there's a corporation involved, they're taxable at all levels. Federal, state, and local. And of course, this only applies to bond interest payments. If there's any capital gains, which means that, I haven't talked about this yet, but it's possible that while you own the bond price could increase. For example, if interest rates go down and you have a bond that's paying you 10%, and then the prevailing interest rates go down to, say, is 5%, you have a very valuable bond there because it's paying more than the prevailing interest rate. So the actual bond price, let's say if you bought it for $1,000, the actual price of that bond during the time that you're holding it will actually increase and go, let's say it goes to $1,200. That $200 is called a capital gain. So if you were to sell it to another investor before it matures, you can do that. You can sell the bond to somebody else and make that difference or make that profit. You're going to have a capital gain of $200 in that trade, and that is going to be taxable at all levels, no matter what. So capital gains are never tax-free. It's the interest payments that might be tax-free depending on the bond and the situation. Bonds are rated using a couple of different rating systems. For short-term bonds, there's what's called a MIG rating by a company called Moody's, and that's a simple one. It's MIG 1, 2, and 3. MIG 1, MIG 2, MIG 3, and MIG 1 is going to be the safest, and of course, if it's the safest, it's going to pay the lowest interest. And those are, again, for the short-term bonds. For the longer-term bonds, there's two companies that do ratings. One is Standard & Poor's, or S&P, and the other is Moody's. And they have rating systems that are similar but not quite the same. So it would be nice if they had lined up these letters, but they didn't. So their rating systems goes from AAA. On S&P is AAA, then AA, then A, triple B, double B, 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 C, and D. And Moody's goes AAA, but then they start using lowercase a's, and AA, A, B, not lowercase b, but lowercase a, BAA, BA, B, CAA, and they don't really go any further than that. And the higher the rating, of course, the safer and the more of an investment grade vehicle it is, and the lower the rating, the less safe the investment is, or the riskier the investment is. And these are divided. So if you cross a line across here, so anything above this line is going to be called investment grade. So these are a special category of bonds where certain institutions that can only legally or by their charter invest in investment grade bonds will only be able to buy bonds that are rated BBB or higher on S&P or Baa or higher on Moody's ratings. And below this line is where the junk bonds come in. That's where the word junk comes from. And again, junk doesn't mean they're all bad, but that's where the riskier bonds are. D is actually default. So S&P has this default D rating if a bond is actually defaulted and is not going to pay, and the company has already stated we're out of business and this is over. They've got this default rating, whereas Moody's doesn't even bother to provide that type of rating. It's important to remember that bonds are interest rate sensitive, and the longer the term of the bond, the more interest rate sensitive it is. And I alluded to that earlier when I talked about bond prices changing. So yes, bond prices can change. When you buy a bond for $1,000, that price over the span of the duration of the bond may vary, because these are all trading on the open market, right? So if your bond price goes up, you can actually sell it for a profit and get out and make a profit. And sometimes also the bond price comes down and you can actually lose money on the face value of the bond. And so if you were to sell it in before the maturity, before the end of the term, you may lose some capital on that. So most of the time people don't do that. Most of the time people wait for maturity, but it can happen where you lose money if you decide to get out of a position in the middle of a term rather than waiting for the end of the bond period to come. The longer that bond maturities are, the more interest rate sensitive they are. The shorter that maturities are, the less interest rate sensitive they are. And so let me give you an example. So let's say you bought a bond, again, for $1,000, and it pays 8% for a 10-year period, let's say. And let's say that during that 10-year period, in the middle somewhere, let's say year 2, interest rates spiked. Interest rates went up to something like, 10, 12%, let's say. So that means that if you didn't have that money tied up in that bond, you could actually use your money to maybe get something closer to 12% as opposed to 8% on your money. But your money is tied up in that bond, so you can't. So that's where you're sensitive to interest rates. You have a risk where if you're holding a long-term bond and interest rates go up beyond what you're being paid for that period, you may actually be kind of losing out on being able to get more money just by the fact that interest rates are now higher. And what will happen if and when this happens is that the bond price, the $1,000 price on the open market, will actually drop. So your bond may then only be worth, let's say, $900. And that can actually happen. And again, if you're watching this in the first half of 2022, that has happened recently with long-term bonds. Long-term bonds were looking really good up until maybe the end of 2021, and they were paying fairly well interest. But as soon as there were rumors of interest rates going up, and as soon as interest rates started going up in 2022, these bonds quickly lost 10, 15, and 20% and higher amounts of their value because of this dynamic that we're talking about here. So the key takeaway here is that bonds aren't always really safe. People think, oh, stocks are the risky ones, bonds are the safe ones, but depends on the bond. You have to really watch out for those long-term bonds in rising interest rate environments, because they can be killers as far as you losing money on your capital if you have to get out of a bond position. If you don't have to get out of the bond position, then it's you just hold and wait it out. But if you have to sell for whatever reason, you may end up losing a lot of money on your investment if it's a long-term bond during a period of time where inflation is going up and interest rates are going up. The obvious conclusion here is, and again, this is general advice, you should always consult your individual financial advisor for specific advice, but the obvious conclusion here is that in a rising interest rate environment, if you're buying bonds, you should be buying short-term bonds and not long-term bonds, because this situation here could end up working against you. The thing to look at when looking at bonds and whether or not they're very sensitive to interest rates or not is this duration. It's one of the things when you go on something like Morningstar.com. That's a independent website that allows you to go do research on stocks and bonds and other investment vehicles. If you go on there and you look at a bond or an investment that deals with debt instruments, they're always going to show you a duration. And the duration doesn't mean strictly the maturity period. It is a calculation that's based on the maturity period and the cash flows of the bond investment over the period of time that you're holding it. And so it's a kind of a mathematical formula. It's not necessarily a one-to-one correspondence to the actual maturity time of the bond, but you can look at the duration to determine whether or not it's going to be interest rate sensitive if it's a long-term kind of investment. So the rule of thumb is the higher the duration, the more sensitive it is. So keep an eye on duration when you're looking at investments and determining whether or not you should be looking at a low duration or high duration. So if it's low, it's going to be less sensitive to interest rates. And if it's high, it's going to be more sensitive to rates. A good way that investors look at bond values or get a handle on bond values is by looking at yields. And the yield is simply a measurement of the return on your money. So the return on your money. And there's different kinds of yields that you can calculate. There's return on your investment. There's different kinds of yields that you can calculate based on the fact that there's different pricing that could happen for a particular bond because of this market dynamic that I've been talking about. So the most common and the most basic one is called the nominal yield, which is very simply the annualized interest payment. So let's say you're going to $50 over the face value or the par value, and the face value we talked about already is $1,000. So in this case, that's going to be 5%. All right? $50 over $1,000, 5%, that's called the nominal yield in this example. But remember, the bond itself can go up in price or go down in price. So let's say the bond went down in price, and when that happens, when there's a price change, then we talk about another kind of yield called the current yield, because the current situation is that the bond price has changed. And the current yield takes into account the current price. And the formula for that is, again, the annualized payment, which doesn't change. It's still the $50 annualized payment. But if the bond, let's say, dropped to $900 instead of the $1,000 that you bought it for, now the current yield is actually going to be higher. It's going to be 5.56%. And that makes sense because you have a lower price, lower number on the bottom that's going to increase the current yield. And another example of current yield, if the annualized interest is still $50 and the price went the other way, the price improved, let's say to $1,050, then your new current yield is going to be lower because, again, now you've got a bigger number in the denominator. Your current yield is going to be 4.76%. And I should have written this percentage over here. Okay, so one thing to notice here is that there's an inverse relationship between price and yield. So if price goes down, yield goes up because of this inverse relationship. Very, very simple to see that, and just because of the way the math works there. Another yield that investors consider is called yield to maturity, or YTM, and that has a bit of a formula. It's a bit of a complex formula. I'll write it out here. I won't do a calculation, but just for completeness, it's annual interest. So that $50 that we've been writing in that other formula would go there, plus any annualized gain or loss. And of course the loss would be subtracted, divided by your purchase price plus your redemption price divided by 2. So the denominator there is an average of what you paid for it and what you got for it when you sold it. And you got your annual interest on the top and any gain that you've annualized or any loss that you've annualized to calculate this yield to maturity. And we won't do an example there, but I wanted just to say that for completeness. And there's another one called yield to call. And that's a special case because some bonds are callable, what they call callable bonds. And callable bonds are the kind where the issuer can say, I'm going to call the bond. In other words, I'm going to pay the bond early. So if you bought a 10-year bond with a callable option, the issuer might say after 5 years, the issuer might say, I've met all my objectives and I'm going to call these bonds and pay them off early. And so there's just another calculation there for the yield to call. It's interesting to look at them and or to sort of how these numbers, how these different yields relate to one another. And as a result, there's 3 kinds of bonds that you could come across, and the simplest one is called a par bond, and that's one where things don't change. There's just it's a bond where there's no trading essentially in the bond, so what you pay for it is what you sell it for, and that's just the way it stays. And it's the least interesting of it, but it's the one we can start with. And the way these things are illustrated is through these little seesaw drawings, and you'll see these par bonds where you've got the par price over here, and then when you're going to sell that price, the level of the seesaw describes the price, and it's not going to change, so that's why it's level. And then the nominal yield is written here, and that's, let's say for example, 6%, and then the current yield is written here, and because it's a par bond it doesn't change, so it's going to stay at 6%. And then the yield to maturity would be written over here, and again it's par bond, so it's not going to change, so it's going to stay at 6%. The more interesting ones to look at are premium and discount bonds. So in the discount bond example, this was a par bond. In the discount bond example, the seesaw is shaped this way, and in this example you're going to have, let's say, $1,000 bond that is selling at a discount. So let's say the price here is going to be $900, and then the nominal rate is going to be, again, let's call it this time 5%, and the current yield is going to be, as the seesaw shows, a little bit higher. So in this case it's going to be, let's say, 5.5%, and the yield to maturity is going to say, let's say it's going to be 6%, right? And so that's kind of how discount bonds look on these graphs. And then you can guess that there's another one where it goes the other way, and yes there is, and those are called premium bonds. And in that example it goes in this direction, and the price is higher than the face value, so it's going to be something like 1100, let's say. And then your nominal yield is going to be something like 6%, let's say. And then your current yield is going to be less, 5.5. Then your yield to maturity is going to be, let's say, 5%. Those are just rough numbers, but just to give you an idea of if you see these yield curves and these yield seesaw pictures, you know why they're there, why they were designed that way, and why they were and why they were put together. So it's kind of just explain that. So that's bonds, and I want to stress again that a lot of people look at stocks and bonds and they say, well, stocks are the risky ones and bonds are not risky ones because they haven't really looked into bonds too deeply. And they think, oh, I'll deal with bonds later in life because I'm young and I don't have to worry about that now. But it is important to learn about the fact that bonds can be risky. There's different levels of them. Some are riskier than others. The riskier ones are going to pay more as far as interest, but they're also going to have a higher chance of default. And there is a very real possibility that you lose money on bonds. Not a lot of people understand that. And so recently that, like I said, that has happened where people put a lot of money into long-term bonds in the late teens, like 2018, 17, 18, 19, and 20, and so forth. And they thought, oh, this is great. I have my money invested safely in bonds, which are really safe, and I'm getting a great interest rate payment. Sometimes some of those long-term bonds during that time were paying a lot better than, of course, short-term bonds and what banks were paying. But if they weren't careful and didn't sell in time, and they held through the time when the rumors of interest rates going up started coming out and interest rates started going up, they lost a lot of money on just the value of those bonds because they're interest rate sensitive. So I just wanted to finish on that thought. If you have any questions, comments, concerns, send me an email, tweet at me. If you have any other topic suggestions, let me know. Other than that, have a great day.